In the world of finance, knowledge is power. Financial advisors hold the keys to their clients' financial futures. To make the best decisions, advisors need a deep understanding of economics. Economics explores how individuals, businesses, and governments use their limited resources to satisfy their unlimited wants. From the price of groceries to the value of our homes, economic forces are constantly at play. For financial advisors, economics serves as a compass, guiding them through the complexities of the financial world. This proactive approach helps mitigate risk and maximize returns. Economics is the study of how people make decisions in a world of limited resources. Economists have divided it into two main branches, microeconomics and macroeconomics. Microeconomics focuses on the small-scale economic interactions of individuals, households, and firms. Macroeconomics examines the economy as a whole. Understanding the interplay between microeconomics and macroeconomics is crucial for financial advisors. Microeconomics delves into the heart of individual decision-making in the marketplace. It explores how consumers allocate their spending among various goods and services. On the supply side, microeconomics examines the behavior of firms. This knowledge helps financial advisors make more informed investment decisions. Macroeconomics zooms out to examine the economy as a whole. It grapples with issues like economic growth, inflation, and unemployment. Understanding these macroeconomic forces is crucial for long-term financial planning. Financial advisors closely monitor macroeconomic indicators to anticipate market trends. By understanding the macroeconomic landscape, advisors can help their clients navigate economic uncertainty. Imagine the economy as a bustling city, with goods, services, and money constantly flowing. This is the essence of the circular flow model, a simplified representation of how money, goods, and services circulate within an economy. Households provide labor to firms in exchange for income, which is used to purchase goods and services. Governments, financial institutions, and international trade all play significant roles in the circular flow. This continuous flow forms the backbone of any economy. Let's take a closer look at the key players in the circular flow model. Households supply labor to firms in exchange for income, which is used to purchase goods and services. Firms use factors of production to create goods and services that meet the demands of households. Governments act as both consumers and producers, injecting money into the economy and collecting taxes. Financial institutions facilitate the flow of funds within the economy, channeling savings into investments. Let's bring the circular flow model to life with a real-world example. Imagine Sarah, a graphic designer working for a tech company. She uses her salary to pay rent, buy groceries, and enjoy leisure activities. The tech company uses Sarah's design work to promote its software product, generating revenue. This continuous flow is the lifeblood of a healthy and growing economy. Just as doctors rely on vital signs to assess a patient's health, economists use national accounts to gauge the overall well-being of an economy. These accounts provide a systematic framework for tracking and measuring a nation's economic activity. National accounts measure the size of an economy, often expressed as its gross domestic product or GDP. They also shed light on how income is generated, distributed, and spent within a country. This information is crucial for policymakers, businesses, and investors. Gross domestic product, or GDP, represents the total market value of all final goods and services produced within a country's borders. GDP measures the size of an economy's pie, reflecting the overall level of economic activity. To calculate GDP, economists sum up the value of all final goods and services produced. GDP can be calculated using the production approach, the expenditure approach, or the income approach. Regardless of the approach used, the resulting GDP figure provides a comprehensive measure of a country's economic output. Gross national income, or GNI, takes a broader perspective than GDP, accounting for income earned by a country's residents, regardless of where it's generated. GNI captures income flows, providing a more accurate reflection of a country's total income. The distinction between GDP and GNI is particularly relevant for countries with significant foreign direct investment or a large diaspora. Understanding the difference between GDP and GNI is crucial for financial advisors. By considering both indicators, advisors can gain a more comprehensive view of a country's economic health. The COVID-19 pandemic sent shockwaves through national economies, highlighting their vulnerability to unexpected events. National accounts became even more critical during this period of extreme volatility. They provided real-time data on the economic downturn, allowing policymakers to assess the effectiveness of policy responses. The pandemic's impact on national accounts varied significantly across countries. National accounts continue to play a crucial role in monitoring progress and informing policy decisions. In today's interconnected world, economies are no longer confined within national borders. The balance of payments, BOP, is a nation's financial ledger, recording every transaction with the rest of the world. The BOP provides a comprehensive overview of a country's economic interactions, offering insights into trade patterns and investment flows. It tracks credits and debits across various categories, providing a balanced view of international economic relationships. The BOP helps policymakers, businesses and investors navigate the complexities of the global economy. Section 2. Deciphering the account's current financial and capital. The balance of payments, or BOP, is divided into several key accounts, each providing a unique perspective on a country's international economic activities. The two primary accounts are the current account and the financial account, reflecting the flow of goods, services, and financial capital between a country and the rest of the world. The current account focuses on the trade balance, which tracks the difference between a country's exports and imports of goods and services. A surplus in the trade balance, where exports exceed imports, indicates that a country is earning more from its international trade than it's spending, contributing to a current account surplus. Conversely, a trade deficit where imports outweigh exports can lead to a current account deficit. The financial account captures the flow of financial capital between a country and the rest of the world. This includes foreign direct investment, portfolio investment, and other financial transactions such as loans and deposits. A surplus in the financial account means that a country is attracting more foreign investment than it's investing abroad, indicating confidence in its economic prospects. In addition to the current and financial accounts, the BOP also includes the capital account, which tracks relatively smaller flows related to capital transfers, such as debt forgiveness or the acquisition and disposal of non-produced, non-financial assets. Together, these accounts provide a comprehensive picture of a country's international economic engagement. Exchange rates, the value of one currency in relation to another, play a crucial role in shaping a country's balance of payments. Fluctuations in exchange rates can significantly influence the price of imports and exports, impacting a country's trade balance and overall current account position. Imagine a country whose currency depreciates, meaning it loses value relative to other currencies. This depreciation makes the country's exports cheaper for foreign buyers, potentially boosting demand and improving its trade balance. Conversely, a currency appreciation, where it gains value against other currencies, can make exports more expensive and imports cheaper, potentially widening a trade deficit. Exchange rates can also influence the financial account, A strong and stable currency can attract foreign investment, as investors seek to capitalize on the potential for currency appreciation and higher returns. On the other hand, a weak or volatile currency can deter foreign investment, as investors become wary of the risks associated with currency fluctuations. Understanding the interplay between exchange rates and the balance of payments is crucial for financial advisors. By monitoring currency movements and assessing their potential impact on trade and investment flows, advisors can make more informed decisions about global asset allocation and manage their clients' exposure to currency risk. At the heart of every market lies a fundamental interplay between two powerful forces, supply and demand. Like two sides of a seesaw, they constantly interact, pushing and pulling prices until they reach a point of balance. Understanding this dynamic is crucial for financial advisors, as it underpins the behavior of asset prices, interest rates, and the overall economy. Demand represents the willingness and ability of consumers to purchase a good or service at various prices. Generally, as the price of a good rises, the quantity demanded falls. Think about it. If the price of your favorite coffee doubled overnight, you'd likely buy less of it. This inverse relationship between price and quantity demanded is known as the law of demand. Supply, on the other hand, reflects the willingness and ability of producers to offer a good or service for sale at different prices. As the price of a good rises, producers are incentivized to supply more of it, as they stand to earn higher profits. This positive relationship between price and quantity supplied is known as the law of supply. Imagine a farmer who can grow either corn or soybeans. If the price of soybeans surges due to increased demand, the farmer will likely allocate more land to soybean production, increasing the supply of soybeans in the market. The interaction of supply and demand determines the market equilibrium, the point at which the quantity demanded by consumers precisely matches the quantity supplied by producers. At this price, there's no surplus or shortage in the market, and both buyers and sellers are satisfied. Imagine a bustling farmer's market where the aroma of freshly baked bread fills the air. If the baker sets the price too high, few people will buy the bread, resulting in a surplus. Conversely, if the price is set too low, the bread will sell out quickly, leaving some customers empty-handed and creating a shortage. The market, however, has a remarkable ability to self-correct. In the case of a surplus, producers will lower their prices to attract more buyers, while in a shortage, the scarcity of the good will drive prices upward. This process of adjustment continues until the market reaches a new equilibrium, where the quantity demanded equals the quantity supplied. This concept of market equilibrium is fundamental to understanding how prices are determined in a free market economy. It highlights the dynamic interplay between supply and demand, where both consumers and producers play a role in shaping market outcomes. For financial advisors, understanding these forces is essential for anticipating market trends, assessing investment opportunities, and guiding clients towards financial success. In the intricate world of finance, economic knowledge is not merely beneficial, it's essential. As we've explored, understanding the forces that drive economic growth, inflation, interest rates, and exchange rates is crucial for making informed financial decisions. From the microeconomic decisions of individual consumers and businesses to the macroeconomic forces shaping global markets, a deep understanding of economic principles empowers financial advisors to navigate the complexities of the financial world with confidence. By grasping the dynamics of supply and demand, the circular flow of income and spending, and the interconnectedness of global markets, advisors can anticipate market trends, assess investment opportunities, and guide their clients towards a more secure financial future. As the economic landscape continues to evolve, embracing a mindset of continuous learning and adaptation will be paramount. By staying abreast of economic developments, analyzing data, and refining their understanding of economic principles, financial advisors can confidently navigate the challenges and opportunities that lie ahead, empowering themselves and their clients to achieve lasting financial success. Thank you for watching. If you found this guide helpful, please like and subscribe to SCOCO Academy for more insightful content on economics and finance.